When you think about your income, what's the first thing that pops into your head? For most of us, right, it's that number on our paycheck. But what if I told you that in the eyes of the tax man, income can be pretty much anything of value you get? We're about to go way beyond the paycheck and uncover all these hidden sources of income you might not even know you have. So let's just start with a simple question. You go and open a new bank account, and to say thanks, they hand you a shiny new toaster. It's a gift, right? A freebie, or could it be something else? We're going to circle back to this, but just keep that toaster in the back of your mind. All right, here's our game plan. First, we're going to blow up the old definition of income. Then, we'll dive into how your money actually makes you more money. After that, we'll check out the perks of company ownership. We'll even get into the tricky subject of income from a loved one who's passed. And finally, we'll tie it all together. Okay, this is the single most important idea we're going to talk about. The official definition of gross income covers almost any value you receive from any source, unless there's a specific law that says it doesn't count. We're talking property, services, yeah, even kitchen appliances. Once you get just how wide that net is, you're well on your way to really mastering your finances. Let's start with the one we all kind of know, interest. You see it in your savings account. It's really simple. It's what you get paid for letting someone else, like a bank, use your money. It's literally your money working for you, earning you more money. And we're back to the toaster. So, is it really free? Well, not according to the tax code. That toaster is what's called a merchandise premium. Since the bank gave you something valuable for using your money, it's treated just like interest. If it's worth more than a few bucks, usually around $10 or $20, it's officially taxable income. That's right, your free toaster might come with a small tax bill. And that toaster example, that's really just scratching the surface. You know, interest income can pop up in some really surprising and sometimes totally invisible ways. So let's dig a little deeper, shall we? Think about this for a second. You lend your sibling or maybe your kid some money to help them out. No interest, of course. It's just a nice thing to do, right? A simple act of kindness. Well, the IRS might actually see a hidden financial transaction in there that you don't. And this is where we enter the kind of weird world of below-market loans. Okay, this is where things get a little wild, but it's fascinating. So look at how the IRS sees this. Even though no actual interest changed hands, the IRS pretends it did. They impute the interest. Basically, they calculate what the interest should have been. Then the rule creates two imaginary transactions. First, your family member pays you that phantom interest, which counts as your income. And second, you immediately give that exact same amount right back to them as a gift. It sounds complicated, but it's all to make sure a loan is treated like a loan and not some sneaky way to hide a gift. Now, before you panic about that loan you gave your cousin for his car, there are some really important exceptions. For small gift loans between people, we're talking $10,000 or less, these rules usually don't apply. And there are other limits for loans under $100,000. The whole point is to allow for normal, small family loans without turning it into a tax headache. Here's another type of invisible interest. It's kind of like earning in slow motion. Imagine you buy a bond for, say, $950. That's going to be worth $1,000 when it matures. That $50 difference, that's your profit. It's called original issue discount, or OID. Now, even though you won't get that cash for years, the tax code makes you report a little piece of that future profit as interest income every single year. It's income you're earning on paper long before it ever hits your bank account. Okay, let's switch gears. We're moving from lending money to actually owning a piece of a company. If you're a shareholder or an employee with stock options, your income isn't just about the dividends you get or the profit when you sell. Oh no, there's a whole other layer of rules here. So employee stock options usually come in two main flavors, and believe me, the tax difference is huge. With a non-statutory option, the second you use it to buy stock at a discount, boom, that discount is taxed as regular income right then and there. But with an incentive stock option, or ISO, there's a massive advantage. You usually don't pay any tax until you actually sell the stock. And if you hold it long enough, your profit gets taxed at those much lower capital gains rates. The bottom line is the timing and the tax rate are totally different depending on which one you have. A lot of companies also offer these things called employee stock purchase plans, or ESPs. They're a fantastic perk. They let you buy company stock at a discount. But you guessed it, that discount has tax implications. So let's just walk through a quick story about an employee named Alice to see how this all shakes out. So Alice's company lets her buy stock for just $55 a share, even though it's already trading at 62. She's instantly in the money. She holds onto the shares, the company does well, and a couple of years later, she sells for $81. Now, this is where the tax rules get pretty interesting. You might think her entire profit is taxed in the same way, but it's not. The government actually splits her gain into two separate buckets. The first $7 of profit per share, which was that discount she got right at the start, is treated as compensation. That means it gets taxed as ordinary income, at the same high rate as her regular salary. But the rest of the profit, that other $19 per share that came from the stock growing in value, that's considered a long-term capital gain. And this is great news for Alice, because it gets taxed at a much, much lower rate. So get this. One stock sale created two different types of income, with two totally different tax bills. Okay, for our last section, we're going to touch on a more sensitive subject, but it's incredibly important for financial planning. It's about income that was earned by someone who passed away but wasn't actually collected before their death. It's called income in respect of a decedent, or IRD for short. This quote absolutely nails it. IRD is basically income that a person had a right to receive, but they passed on before the money was actually paid out. Just think of a final paycheck or a sales commission or an earned bonus. That money doesn't just disappear. Instead, it gets forwarded to whoever inherits the right to collect it. This table lays it out pretty clearly. A salary that was earned but not paid out yet, that's IRD. Rent that was due but hadn't been collected, also IRD. But if the money from selling a house was already in the bank before death, that's not IRD, it's just regular income on their final tax return. It all comes down to one thing: timing. Was the cash received before or after death? Let's make this real with another quick story. This is Frank Johnson, a farmer. He sells a huge load of apples for $2,000. The deal is done, the apples are gone, but before the check shows up in the mail, Frank sadly passes away. That $2,000 payment is textbook IRD. The right to collect that money now passes to his widow as part of his estate. And when she finally gets that check from the apple buyer, she is the one who reports the $2,000 as income on her own tax return. The income literally follows the person who receives the cash, not the person who earned it. So we have covered a lot of ground here, right? From toasters to stock options to inherited income. What does it all mean for you? Well, it means your financial world is probably a lot more complex than just your salary. As we've seen, your true financial landscape is so much bigger than your paycheck. It's built from all these little pieces: the interest from a bank's freebie, that phantom interest from a family loan, the slow burn income from a bond, the complicated gains from stock plans, and yes, even income passed down from a loved one. Just recognizing that these things even count as income is the first and most powerful step you can take. And that brings us right back to you. Now that you know just how broad the definition of income really is, what hidden sources might be lurking in your own financial life? Are there any free toasters or informal loans or company perks that maybe you need to look at in a new light? Just knowing where to look is half the battle. Thanks for tuning in.